All right, so last week was a huge week with all the bank failures or almost failures. Obviously SVB and Signature Bank, and then of course First Republic went under the microscope, and that caused a lot of panic. A lot of people ended up pulling their money and moving it to some of the bigger banks or spreading it around to multiple banks. They were rushing to open all these bank accounts and do all these crazy things. Let me break down for you this FDIC insurance for $250,000. Because there's a lot of misunderstanding. So a lot of people listen to the media, whether it's CNN or, podcasts, or took to Twitter or social media. And there's a lot of misinformation there. So this FDIC insurance requirement, or FDIC insurance that says that they insure up to $250,000 of your money, is accurate. Like to a point, right? So there's more caveats. There's not just one rule that says, oh, the FDIC insures $250,000 per account. It's not that simple, right? Like things are much more complicated than that. So let me break it down for you. What the FDIC does say, and then what the media doesn't tell you, because it doesn't sound as attractive or scary, is that it's per person. So for example, I have a account with my husband. And so our personal bank account with me and Kenny is insured up to $250,000 per person. So that means we actually have $500,000 insured on our personal account. Guess what? If I add my two children as beneficiaries, that means I'm covered for $1 million, right? Because now my kids are beneficiaries and they're going to insure $250,000 per kid plus the two of us. That's $1 million. Same thing goes for if you have business accounts, or whether it's an LLC, S Corp, C Corp, whatever. All of the people that are owners of this account are insured $250,000 per person. So for example, if you own a property with 4 partners in an LLC, that LLC account is covered for $1 million because you have 4 partners. Now, let's take it another step further. Let's say you have personal accounts where you have beneficiaries of a trust. If you have 2 kids, 4 kids, 6 kids, whoever the beneficiaries are, it's $250,000 per person. Now, the next thing is, I know that there are escrow companies and property managers and things like that who probably panicked and moved a bunch of their money around. Guess what, guys? If you're an attorney, you're a property manager, anybody is holding money as a fiduciary or in a trust account, your clients, you're covered per client too. So not only are you covered for the $250,000 because you own this account, all of your clients that you're holding money for in trust, they are each covered for $250,000. So, if you have millions of dollars sitting in an account, but you have hundreds of clients that you have money you're holding for, like an escrow company would do, or even a property management company might do, each of your clients is covered up to $250,000. So an analyst wrote this article last week about First Republic and said First Republic had 68% of their deposits uninsured. That's inaccurate because that analyst only basically was able to say, okay, First Republic Bank has X amount of bank accounts times $250,000. That means that 68% of their deposits are uninsured. That is inaccurate because that analyst does not know how many people own each account. It'd be a much more complicated formula for them to determine the actual accurate percentage of uninsured deposits that First Republic Bank is holding. So that is a wild statement. It is meant to freak you out. It is meant to get a lot of eyeballs on that article and cause a lot of talk, right? That's what media likes. So completely inaccurate. Now, in terms of lending, where are we? Because now I've gone on my rant. I've explained to you what the FDIC insurance actually is, and we can kind of talk about what that's doing for rates and real estate and all that good stuff. So rates, treasuries have kind of been up and down, up and down. In fact, last week, some of the treasuries were taking like 25 to 50 basis point swings in one day, like up and down, up and down, up and down. It was crazy. So banks don't like when rates move this much. There's also a lot of uncertainty in the market. So a lot of our lenders increase their spreads about 20 basis points, even though treasuries dropped drastically, anywhere from like 40 to 60 basis points. So you ended up getting a rate improvement, which was like 20 to 30 basis points, but it wasn't the 40 to 60 basis points that the treasuries dropped. And part of that is because it's like, hey, what is this going to stick, right? Because already the treasuries have been pretty volatile. Last week, they were even more volatile. So banks do not want to like ride this roller coaster. They want to kind of keep things more even. So after the treasuries took a huge drop, they increased their spreads about 20 basis points. Not to mention that every bank is having to go back to the drawing board and look at what they've got. Like, how healthy are we? What kinds of things do we have outstanding? What does it look like if, there's another bank run on our bank? All of these things. So there's a little bit of protection in there. From the treasury volatility, protection in there to let them do more homework and make sure that they're healthy, because a lot of lenders are scaling back on the things that they're willing to lend on. This is certainly going to cause more issue because all these small banks who bank all these local businesses, local real estate, have relationships with people where they've been able to do lending. Some of them are not going to be able to do that lending anymore. It's going to be more tough to get these deals through because obviously this is causing chaos. That being said, there is some benefit for real estate, right? Because treasuries dropped, you got a little bit of reprieve. We had a lot of clients who locked in last week on cash out as they were thinking about getting cash out, obviously to have, cash for opportunities. Maybe they're upgrading properties and things like that. So they were able to lock in their loans and move forward with refinances, pull some cash out. Some of the brokers I'm talking to have also seen a little bit of an uptick in activity, which is really good. So if you're a smart real estate investor or you've been through a couple of these cycles, perhaps you're looking at this going like, great, this is going to speed up the recession, which means that there are going to be opportunities to be had here because a lot of millionaires are made in recessions, multimillionaires, billionaires, those kinds of things. Because if you have cash, cash is king right now. We used to say cash is trash. That used to be the saying, but now cash is king because it's dwindling, right? So if you have cash and you can seize opportunities, recessions are a great time to significantly increase your net worth and have some serious wins. So we are seeing that. The other thing that we're doing for clients, and we're doing a lot of, are lines of credit. So lines of credit are not super available for commercial properties. In fact, very few banks do them. A lot of lenders that give you a first trust deed do not like you to get lines of credit. However, it happens. So we're doing a lot of lines of credit for clients that want to be ready for the opportunity. Now, the downside of a line of credit is that it's a higher interest rate, obviously tied to prime. And also that your first lender might not be super happy about that. In fact, there is a possibility that they can call the note. But if you get a line of credit, the cool thing is that you only pay interest on what you borrow. So if you're not ready to buy a property right now, you don't see any opportunities, maybe you end up finding an opportunity 3 or 6 months down the road. The cool part is that you didn't pay any interest on that money during the time that you didn't need the money, which is really great. You're also paying a higher interest rate on a smaller dollar amount if you have a first trust deed locked in, which is probably at a very low rate. So that means in the future, once you buy a property, you draw on that line and use it to put on a down payment on a property, or maybe to renovate a property, that you can eventually, at some point, when it makes sense for you, when your prepay burns off, or when your fixed term is up, that you could refinance and pay off that line of credit with a new loan. So that is a strategy that a lot of people are using right now. We're doing lines. They're, like I said, they're not super available. We've been doing them for years, to be frank. A lot of people who have a ton of equity in their properties like this idea of getting a line of credit, especially when they're kind of like thinking, I want to have cash for opportunities, but I don't know when I'm going to find it. So we have been doing a lot of lines of credit over the years, and we're doing even more now. Now, lines of credit are very difficult to find. Most banks don't do them. We happen to know the handful of banks that are doing them against multifamily or commercial in first or second position. So that is a huge tool that you can use to take advantage of opportunities in the future. So anyways, you guys, I am so thankful. I get a lot of emails and I get a lot of response off of these weekly videos that I do with my rates. I appreciate you, and it does not go unnoticed. I'm happy that you guys are loving the content. If you think that someone would benefit from this, please do forward my email. They can always subscribe as well to the weekly emails. Also, we have our weekly podcast. We have a lot of different guests that come on. So if you haven't watched the podcast before, go ahead and skim through the episodes. I'm sure you'll find at least something that might interest you. And I really appreciate you guys. So if there's anything else that you want me to cover on these weekly videos, feel free to email me and let me know, and I can cover them in future videos. And if you have any questions in regards to what you can do with your portfolio, a property that you're looking at, you're not sure about financing, please do reach out to me, send me an email. I'd be happy to take a look. I've gotten a ton of requests of these videos, and keep them coming. I really, really appreciate you guys, and it does not go unnoticed. So thank you so much.